In this video, we will discuss about tax harvesting in detail. This video has 3 parts. In the first part, we will discuss the basic concept of tax harvesting, what it means and how it can benefit you. In the second part, we will discuss some of the things that you need to keep in mind while doing tax harvesting, some of the challenges that you may encounter and how to tackle them. In the third part, we will specifically deal with SIP investments. The problem with SIPs is that the transactions happen over months while you're investing, and determining how many units exactly to sell to harvest the right amount of tax can be a little confusing. So we'll go through some Excel workings to find out how to do that. Remember, this video doesn't cover loss harvesting, which is a slightly different concept and is covered in a separate video. I hope you're all aware that when it comes to investments in equity shares or equity mutual funds, when you sell those investments and if it has been held for more than a year, the gains will be considered as long-term capital gains. And long-term capital gains in India is taxed at 12.5% per annum over and above an exemption limit of 1.25 lakhs. Let's say you liquidate all of your equity investments in one particular year when you need those investments. Let's say when you want to buy a house or at the time of retirement. Such a sale would result in a huge outflow of capital gains tax because only 1.25 lakh will be exempt and anything beyond that will get taxed. The idea of tax harvesting is that instead of selling all of them in one shot, you sell portion of the unit in every year so that you can make use of the 1.25 lakh exemption in each of those years. So your overall tax liability over the long term will reduce significantly. You do that by selling some of the units and immediately buying it back so that your overall investment remains the same, but it's just that you will be recording the purchase and sale transactions on your books. We'll discuss in a little more detail with the help of an example. Let's assume that you make a lump sum investment of 6 lakh in 2024. Over the years, the value rises and becomes around 13.5 lakhs in 2030. Now, a person who is not aware of the concept of tax harvesting would probably just sell all the investment in 2030. This would result in a profit of around 7.5 lakhs. And after considering the exemption of 1.25 lakh, the taxable gains will be around 6.25 lakhs. Now, at the current rate of 12.5% per annum, you will have to pay a tax of around 78,125. If you were to do tax harvesting, what you need to do is that in the first year in 2025, when the value of the investment reaches around 7 lakh rupees, you can sell them and buy it back immediately. You are not exiting the investment because your overall investment remains the same. You are just recording a sale as well as a purchase. With this, your profit gets booked. So if we evaluate the profit, it will be 1 lakh rupees. And because 1.25 lakh is exempt, your tax will be 0. Similarly, after one more year, let's assume that it reaches around 8.25 lakhs. You will sell this and buy back again. Now, when you compute the profit, it will be 8.25 lakh minus 7 lakh, which is the price what you paid in the previous year when you bought it back. Because the original units which you bought at 6 lakh would have already been sold. So now your profit is 1.25 lakh, and because that is exempt again, once again the tax will be 0. So you keep repeating this process every year possible. In the final year, when you sell all of your investments, you are making a profit of 1.5 lakhs. Because only 1.25 lakh is exempt, on the remaining 25,000, when you pay the tax of 12.5%, it works out to 3,127. So you can see that by using this tax harvesting, you are in total saving 75,000 rupees. That is your gain. Now, one thing to note here is that you cannot completely eliminate all of your tax, because you can save only to the extent of 1.25 lakhs per annum. So in this year, because the overall profit was more than that, you ended up paying a small amount of tax. So as your investment corpus grows, it is possible that your per year gain may become 2 or 3 lakhs, in case of which you will still not be able to save all of the tax. You will be able to save only to the extent of 1.25 lakhs. Now, if you were to estimate how much is the extent of your actual savings, it is 1.25 lakhs into 12.5%. which is 15,625 every year. So if you do this every year, let's say for 20 years, that will be 3.12 lakhs. And this tax benefit is directly linked to the tax rate, because last year the exemption available was only 1 lakh rupees and the tax rate was also only 10%. So at that time, the benefit was 10% of 1 lakh, which is nothing but 10,000. But because the exemption limit also increased and the tax rate also increased, now the benefit has improved to 15,625. The point I'm trying to make is that tomorrow, if the tax rate becomes 30%, the effective benefit will be 37,000 rupees per year. In that case, you can see that you would have ended up paying a tax of 1,87,500, and now you will end up with only 7,500, which is a gain of 1.8 lakh rupees. And that is quite substantial. So in my opinion, you should make use of this facility to the maximum extent possible every year till the time it exists. But there are certain things that you need to keep in mind while doing this tax harvesting. First of all, this option is available only on equity shares and equity mutual funds, which means that you cannot use it on debt mutual funds. The rules associated with short-term and long-term capital gain for debt funds are completely different, and the 1.25 lakh exemption is not available at all. Secondly, as I had already touched upon, this is available only on long-term capital gains, which means that you need to hold your equity shares or equity mutual funds at least for a year before you sell them in order to make use of this benefit. If you sell your equity mutual funds before a year has lapsed, not only will you have to pay more taxes under LTCG, you will also incur exit load. So you should be careful about that. Thirdly, and most importantly, when it comes to equity shares, you have to be careful to not enter into intraday transactions. I'll explain this also with an example. Let's say that you had purchased some share in April 2015 at 50 rupees per share, and you're planning to do tax harvesting in 2025. So on 20th March, you bought as well as sold at 110 on the same day. Because these two transactions happened on the same day, it will be treated as an intraday transaction, and these will be cancelled off against each other. And as a result, the purchase price will not get updated from 50 to 110, as these both will get set off against each other and will not be considered at all. So if you sell the units in 2030 for 180, your profit will still be computed as 180 minus 50, which is 130. So the whole purpose of doing the transaction itself will get completely defeated. So what you need to do instead is execute the trades on two different dates. Instead of buying and selling on the same day, you can buy on one day and sell on the other day. Now what would happen is that these units will be considered to be sold on this day, and hence a profit of 60 per share will get recorded in 2025. And in 2030, when you sell these units, the remaining 70 rupees will get recorded. So this way you will be able to split the profit across the years and benefit from it. So you need to be careful not to do intraday transactions. But here one thing you need to be careful is that when you buy and sell on two different dates, you will be exposed to the price fluctuations that could happen within that one day. So you have to undertake these kind of transactions only when the market is relatively stable and not when it is very volatile. Also, if the price does happen to go up, try not to wait for the price to come back down, because then it could continue to keep going up and you will end up speculating. But in mutual funds, you don't have this problem. You can buy and sell on the same day. In fact, if you place your orders before 3 p.m. on the same day, you can lock in the same NAV, and hence you won't be exposed to any price fluctuations. But the problem with mutual funds is liquidity. Let's say you want to sell mutual fund units of 7 lakh rupees in order to harvest 1.25 lakhs of profit. Your sale proceeds will hit your account only after 2 days. So if you want to purchase the units on the same day, you need to have 7 lakh rupees with you right now. And that can be a bit challenging. You have two possible options here. One is to take the risk exposure. That is, you sell your units today, wait for 2 days, and once the money hits your account, you make the buy. And since mutual funds are not as volatile as individual shares, the difference may be quite minuscule. The other option is to split the transaction into multiple deals. Let's say you have 1 lakh rupees right now, you can sell as well as buy for 1 lakh today, and after 2 days when that 1 lakh hits your account, you can execute another trade for 1 lakh. Like this, you will have to repeat the transaction 7 different times to complete the entire deal of 7 lakhs. So this can be a little time consuming, and hence I will leave it up to you which of the two options you want to consider. One more thing that you need to be careful about with mutual funds is that certain mutual funds do not accept lump sum investments. So if you have your investments in one of those mutual funds, you would have invested 7 lakh over multiple SIPs, but when you sell it and you go to buy back 7 lakh worth investments at once in lump sum, they will not allow that. Then your only choice would be to choose another fund which will allow a lump sum investment. So if you really love the fund and it has been doing really well and you don't want to exit out of that fund, then tax harvesting won't be an option with that fund. Finally, if you are trying to harvest tax on your SIP investments, finding out how many number of units to sell can be a bit of a hassle. So we'll go through some of the workings. I have downloaded the transaction history of my SIP from the mutual fund portal, and after cleaning up the original download a bit, I was able to get this Excel sheet with these 4 data points. So I need the date, the amount, the price, and the number of units. Here I'm going to calculate the cumulative total of units that I have. So in February, I will be having these 112 plus 87 units. and I will double click it to get the cumulative total. I'll type in the NAV value that I get as on date, which is around 82.16. Now if I sell these 112 units, I will be able to get 9,203 rupees. I will freeze the reference to the price. So if I sell 548 units, I will get 45,000 rupees. I also need the cumulative investment amount. So I will insert a column here and sum this up the same way. Now my profit will be this total realization minus the investment amount. So if I sell all the investments that I made till December 2018, I'll be getting 50,000 profit. So I want to record transactions up to 1,25,000. Now one thing you need to keep in mind is that the 1,25,000 is the exemption that you can claim in total, putting all the shares and mutual funds together. So if you already have sold some shares on which you have some long-term profit, you have to deduct that. So if you have 10,000 profit, you will be able to claim only an additional 1,15,000 rupees. So here I'm assuming that there is no other additional exemption that I'm claiming. So I can claim up to 1,25,000. So I will look for 1,25,000. So if I sell all these units that I bought till Jan 2020, I will be able to make 1,25,434. So the excess 434 can get taxed. So I'm not going to sell all of this. I will sell everything till here. But what I can do is in Jan 2020, I have purchased 75 units. I can sell a portion of these units as well to stay below 1,25,000. So I will insert a row here. I'll put this date. The price will be as on this date. And number of units for now, I'm just going to take 10 units as a sample. Balance unit will be cumulative of this. My realization will be same. The investment amount won't be the entire 3,000, but instead it will be only 10 units at 39 rupees. So this will be 398. So my cumulative investment will also change. Once I sell these 10 units, I won't have the entire 75 units left. So what I will be left with is this 75 minus 10. And my investment amount will also change. Out of the total 3,000, I'm already selling investments worth 398. So what I'm left with is only worth 2,601. I have split the total number of units that I bought in Jan 2020 in two different lines, out of which I am planning to sell only 10 initially. So even if I sell another 10 units, I'm well below the limit of 1.25 lakhs. So maybe I can sell another 35 units. Right, so out of the total 75 units, I am selling 35 units now and I will be left with another 40 units. Now it is necessary to keep track of this because next year when I calculate the cumulative investments, it will start from this 40 and then it will be 40 plus 49 and so on. And similarly, my investment value also will start from this 1,604 and to that the subsequent investments will get added. So my profit counting will start once again from here, after accounting for these 35 units. So till here if I sell, I will get 1,23,000 profit. And so the total number of units that I need to sell will be 2,703.603 units. You can take note that I did not put in the entire 1,25,000 because this NAV that I have is today's NAV. By the time I put in the order and it gets executed, the NAV may go up. Let's say it becomes 82.56, right? Then the profit can become 1,24,814. So that's why I wanted to give a little bit of buffer. So what I need to sell is this 2,703.603 units. Now I can get rid of this decimal value minus 0.603 and the balance gets adjusted here because I have linked it. So I can proceed to sell 2,703 units in my investment portal. Once you actually execute the trade, you can take note of the NAV value at which it got sold and then you can come back and update it here. Let's say it is 82.36. So you will know that the profit will be around 1,24,247. You can also download the capital gain statement from your mutual fund portal and mostly it should match with this. And that is what you can declare while filing your tax returns. With this, I hope I have covered all the issues relating to tax harvesting. If you have any further queries, you can post them in the comments below and I will try to address them. If you found this video useful, please hit the like button and subscribe to the channel for more such content, and don't forget to share it with your friends and colleagues who might need this trick. It is a perfectly legal method and we should be utilizing it to the maximum extent till the time it is available.